If you've bought anything online in the last couple of years, you've probably noticed some new payment options when getting to the checkout page of many online retailers. Companies like Affirm, Afterpay, and Klarna have all started offering buy now, pay later services that allow users to pay for their purchases over a series of installments rather than paying up front and in full at checkout. The rise of this new payment form represents a major shift in the payment industry, offering consumers increased flexibility in managing their finances while avoiding the oftentimes aggressive fees associated with credit cards. And demand for buy now, pay later services clearly reflects consumers' love for this new payment method. Because from 2020 to 2022, the share of Americans who've used buy now, pay later services grew from 20% to over 55%. And this increasing popularity has led the total amount of sales, also known as gross merchandise value, bought using this payment method to grow significantly. Because from 2019 to 2021, gross merchandise value purchased using buy now, pay later financing grew from $3 billion to $55 billion, and is projected to reach $114 billion by 2024. And with this type of demand, legacy payment companies have scrambled to respond and keep up with the ever-changing preferences of consumers. For instance, on August 1st of 2021, Square shook up the fintech space by announcing its acquisition of buy now, pay later provider Afterpay for $29 billion. This in turn was met with a flurry of other payment platforms rushing to announce their own entrance into the buy now, pay later market, with PayPal announcing its own offering later that month and Visa following suit in early September. But with so much attention being paid to buy now, pay later, I figured we should take a look at the underlying business model to get a better understanding of the market overall and determine for ourselves whether the hype is truly justified. But first, what exactly is buy now, pay later? A common phrase in the retail sector is point of sale, which is the time and place where a retail transaction is completed. Think the checkout aisle at your local grocery store, or the checkout page of an online store. Typically, consumers have had two options when it came to how they would finance their purchase at the point of sale. The first option would be to pay in full upfront using cash or a debit card. Alternatively, they could use credit, typically through a credit card where consumers use borrowed money to pay for an item and then reimburse their credit card provider at the end of the billing cycle. However, over the last few years, a third option has become increasingly available, known as buy now, pay later. At its core, buy now, pay later is simply an alternative form of paying with credit. Similar to paying with a credit card, buy now, pay later lets consumers make a purchase and receive it immediately, but pay for it at a later time. However, buy now, pay later has three key distinctions when compared to a conventional credit card transaction. First, using buy now, pay later, consumers pay a portion of the price up front out of their own pocket, usually between 20 to 30%. In addition, the outstanding debt is paid back over a series of installments, usually weekly or bi-monthly, instead of paying the entirety of the balance at the end of the billing period. And third, the service is completely free and doesn't charge any interest rates. But for those users who do make a late payment, buy now, pay later providers often charge a small fee. However, these fees are nominal compared to credit card providers. For example, Klarna charges a fee of up to $6, but even that fee is capped at 25% of the consumer's order value. But in order to see how this new payment method translates into a real market opportunity over traditional forms of payment, we need to understand how buy now, pay later positions itself within the payments market. The payments market is based on a fundamental dilemma that all consumers face, which is the need to balance their inflow of income with their outflow of expenses. This represents an inherent challenge because the time at which consumers incur expenses doesn't often overlap with the time when they receive their income. Typically, consumers receive their wages twice a month. However, consumers incur expenses like groceries, rent, or transportation costs at various points throughout the month that they can't just hold off on consuming until they get their next paycheck. So consumers will naturally look for a way to bridge this gap. Economists refer to this as consumption smoothing, which describes consumers' desire to have a stable pattern of consumption between periods of high income and periods of low income to obtain more stability and predictability. And this phenomenon led to the rise of the credit card industry, who recognized that consumers' desire to have a stable consumption pattern created an arbitrage opportunity. Because by providing consumers the funds needed to bridge the gap between their current expenses and their next paycheck, they could charge interest for providing this liquidity. But buy now, pay later positions itself as a middle ground between paying in cash up front versus taking on debt via a credit card. Because unlike paying with a credit card, buy now, pay later doesn't include any fees, so you pay the same amount that you would if you opted to pay using cash or a debit card. On the other hand, it has the advantage of not having to pay the full price of a good up front that paying using cash or debit requires. But at this point, we should all be wondering how such a business model would work. After all, credit card companies make money by charging interest, right? So how can buy now, pay later provide consumers the liquidity they desire if they don't charge interest to their users? Well, this is where things get interesting, because the business model of buy now, pay later is pretty fascinating. See, traditional credit card companies make money when users don't pay back the money they borrowed at the end of their credit cycle, oftentimes leading to exorbitant interest rates, which average out at around 20% of the outstanding balance. So the ideal customer for a credit card company is someone who spends a lot and then doesn't pay back their outstanding balance. However, unlike credit card companies, the ideal buy now, pay later customer is someone who pays back on time, all the time. In fact, most buy now, pay later companies perceive users who pay late as a cost of business rather than a revenue opportunity. For example, Afterpay charges late fees of up to $8 per late payment, but payments are capped at 25%, at which point users are banned from the platform until they pay their outstanding balance. This is because the business model of buy now, pay later doesn't actually derive any revenue from its users. Instead, buy now, pay later providers make their revenue from retailers who offer their service as a payment method on their platform. But why would retailers pay these companies? Well, because offering this payment method leads to a massive increase in revenue for online retailers. Specifically, it boosts revenue for these merchants through 4 key avenues. First, offering buy now, pay later financing boosts the number of potential customers who visit a retailer's site. For example, in an earnings call, the CEO of Afterpay said it drove an average of 1 million leads per day across all of its merchants in 2021. The second avenue is an increase in conversion rates, which is a metric representing the percentage of people who visit a store and then leave having purchased something. Klarna, for instance, reported increasing average conversion rates by 20% across all of its retail partners. And third, the service increases average order value, which is the average dollar amount spent each time a customer places an order on a website or mobile app. One study showed that Affirm increased average order value by 85% across its network of retail partners. And lastly, buy now, pay later increases the probability of repeat purchases, because once a customer realizes that a site offers buy now, pay later, they're more likely to return in the future. For instance, Zip has been shown to increase probability of repeat purchase by 80%. And in return for increasing retailers' revenue, buy now, pay later services take a slice of the merchant's revenue, ranging from 1.5 to 7% from each transaction. Now, this fee is quite high relative to the cost of typical debit or credit card transactions, which range from 1 to 3%. However, the increased revenue associated with adopting buy now, pay later as a payment option often justifies paying this increased commission. And these commission rates translate to a really attractive variable margin profitability for the buy now, pay later firms. For instance, research by Moody's estimates that Afterpay's average fee charged to its retail partners is 4.1% per transaction. After accounting for variable costs, such as processing fees and losses from users who don't repay their loans, Afterpay is left with a 1.7% contribution to their bottom line. This in turn translates to a 40% profit margin, which is pretty attractive and begins to explain why so many payment providers are interested in offering the service. But at its core, the business model of buy now, pay later is a demand play. Generally, for online businesses, value accrues to whoever owns the demand. Whoever can amass an audience of loyal users can monetize access to their user base. Think Google's monetization of user search activity, or Facebook's monetization of people's social media activity, or even YouTube's monetization of your attention by inserting ads into videos here on YouTube. And just like all these other examples, the buy now, pay later business model is attempting to monetize access to a user base of shoppers. But this becomes pretty obvious when we take a look at the user interface of many major buy now, pay later platforms. Take Klarna, for example, which currently holds 21% share in the buy now, pay later market. Third in place behind Affirm, which holds 34%, and Afterpay, which holds 26%. Because when we take a look at their app, you wouldn't really think that it's a payment provider, since so little real estate is actually related to payments. Instead, most of the app is dedicated to shopping, with space designed to feature Klarna's shopping partners like Amazon, Nike, Walmart, and Target, who Klarna likely has favorable commission terms with. And to manage the shopping experience, Klarna provides a bunch of features that increase user engagement. Features like package tracking, managing returns, creating shopping lists, and reward programs all ensure that users keep coming back to the app and increase the likelihood that Klarna will become the go-to destination for users to satisfy their shopping needs through. And once engagement increases, the effectiveness of the ads that users see and the featured retail partners that Klarna chooses to show to users increases dramatically. Because unlike traditional payment services like debit and credit card providers who only get high-level access into users' purchasing behavior, buy now, pay later providers know exactly what their users purchased. For example, say you went to Target's online store and ordered the latest Call of Duty game for your PS5. If you opted to pay using traditional payment methods, your credit or debit card provider would only see that you spent $55 at a store called Target.com. A buy now pay later provider, on the other hand, would know exactly what video game you bought, giving them information about what type of video games you like and what console you like to play those video games on. And this level of granularity dramatically increases the effectiveness of targeted advertising. Because now that Klarna knows this information, it can show you ads for PS5 games similar to Call of Duty, or even expansion packs and add-on features for the exact game you bought. This in turn increases the relevancy of its ads, and dramatically increases the likelihood that you think, yeah, an expansion pack for that video game I bought a couple months ago sounds awesome, which obviously fuels more purchases through Klarna. So with all this, Klarna and other buy now pay later providers are creating a flywheel effect. After consumers first discover buy now pay later financing while shopping online, they make their first purchase using the service, given the attractive flexibility its payment terms offer. This in turn leads consumers to make more visits to the provider's platform, like their app, which creates more opportunities to upsell consumers since users will see ads and featured shopping partners that are highly aligned to the consumer's prior shopping history. And this in turn incentivizes more merchants to offer buy now pay later financing to get exposure to this highly attentive consumer base, which obviously leads to more purchases using buy now pay later, and on the cycle goes. All the while with buy now pay later providers extracting their 2 to 7% commission on each purchase and the 40% profit margin each transaction provides. But of course, the buy now pay later business model isn't without its weaknesses. The service exploded in popularity during a period of unprecedented economic expansion, where the stock market was experiencing one of its longest bull runs in history and consumer confidence was at an all-time high. So many critics rightly question the business model's ability to weather a period of economic downturn. After all, the buy now pay later industry has benefited from historically low interest rates this past decade, which provide cheap capital to finance loans these services provide to users. But as interest rates begin to rise and fears of a recession loom, it's uncertain how these companies will respond. However, when compared to more traditional credit providers, two unique features of the buy now pay later business model might improve the industry's ability to navigate an economic downturn. The first of which is the fact that buy now pay later is overwhelmingly used to finance small ticket purchases. In fact, if we look at the breakdown of products purchased with buy now pay later financing, we see that almost all of them are small ticket items. Here we can see that 32% of purchases are clothing items, 21% are marketplace purchases like Amazon or eBay, 19% are for cosmetic merchandise, and 17% are electronics related. This means that a buy now pay later portfolio of loans is composed of many small loans. So during a recession when we might expect some loans to default, any single loan wouldn't have an outsized effect on the overall portfolio, which theoretically wouldn't be the case for more traditional credit providers who provide fewer loans that instead finance bigger purchases like a mortgage or a business loan. But in addition to the type of loan provided, the actual duration of the loan provided by these services is likely to improve the industry's resilience during an economic slowdown relative to more traditional credit providers. Traditional credit providers like a bank often provide long-dated credit, like a 30-year fixed mortgage for someone looking to buy their first home. However, providing this type of long-dated credit means that these institutions have to keep this credit exposure on their balance sheet for a long period of time. Buy now pay later providers, on the other hand, don't have such long-dated credit exposure because buy now pay later transactions are typically paid back in 4 to 6 weeks. This means that the capital it uses to finance loans for its users turns over much quicker on their balance sheet relative to more traditional credit providers. And this provides buy now pay later providers a lot more agility when it comes to extending credit. So in the event of an economic downturn, buy now pay later providers could quickly react by tightening the screws and standards around things like new users, which products they provide loans for, and which geographies they want exposure to. The impact of this is that buy now pay later providers can quickly decrease the overall risk profile of the outstanding loans on their balance sheet relative to more traditional credit providers, and as a result, improve their ability to weather an economic downturn. But of course, let me know what you guys think about buy now pay later and the payments industry overall. Personally, I'm a bit surprised that so few consumers are aware how buy now pay later providers make money, and I'd be curious to know how more consumer awareness would impact demand for their services. I mean, if you think about it, the buy now pay later business model actually has many similarities to the payment for order flow business model of many commission-free trading platforms like Robinhood, which after all received a ton of backlash from the public after people realized the inherent conflict of interest that Robinhood has under its payment for order flow business model. But if you think about it, buy now pay later kind of takes this conflict of interest to a whole other level by promoting certain vendors to users. I mean, imagine if every time users logged onto their Robinhood account, certain stocks were promoted over others based on deals made between Robinhood and the companies of the stock that they're offering to users. I mean, I can't imagine that would be too popular, right? But of course, I'm curious to hear what you guys think. Have you ever used Buy Now Pay Later to finance your shopping? How was the experience? And can you see this payment method increasing in popularity over time? Or do you think it's just another passing fad of the fintech boom? Let me know in the comments down below.